capital hungry. In this session today, we're gonna talk about me, myself, and Jeff, and my partner as well, Yusuf from Uncle Bull. We're gonna discuss the article we wrote about the ticking bomb, about the next US collapse, probably. So first, I would like to start, Jeff. I want to say we are now undeniably in a very, very strong recession.
Mm-hmm.
And despite this very strong recession that we're in, we're seeing US 30, US 500, the Dow Jones and the S&P soaring, the stock market is soaring in general, cryptocurrency is soaring. So let's start to talk a little bit about that. So why do you think that's happening instead of the opposite?
Okay, so we have to understand that besides just looking at the specific event that happened around coronavirus and how the markets are so bullish, and when I say the markets, I'm talking about equities, like how you just said, US stock markets in specific, we'll use as an example. Before looking at that, we have to understand that our economies go through these economic cycles every 10 to 15 years. Like this happened in 2008, just there was a different catalyst at play. Back then, it was the collapse of mortgage-backed securities that led to the financial market. Different triggers, right? And then 10, 15 years before that, you had something around the Y2K time, around the year 2000. But this, what I like to call it, transfer of wealth, that is correlated and comes alongside these economic cycle changes, is something that is meant to happen in the financial markets. So this V-shaped recovery we're seeing, it is exactly proportionate to the amount of US dollars the Federal Reserve is printing and putting into the markets and injecting into the US markets. But what we have to understand is when the markets first crashed, and like during the coronavirus, when the pandemic markets came into play, and we saw Dow Jones, for example, or the S&P wipe out years worth of financial gains in the stock market in like a matter of a week or month period, it doesn't matter. Who were the losers during that period of time, right? Like, so when that crash happened, where did all that sell side liquidity come from? Who was it taken from? Okay. A lot of people ignore that when they're looking at the market crash, because a lot of us as traders, it's very easy to be in the scope of just looking at the chart and being like, oh, this chart is so bearish or this chart is so bullish, but not understanding that equities chart, that stock market chart is impacting real working class people, day-to-day working class people who have their money through either their employer or through their bank being invested into the stock market, whether it's for a savings plan, whether it's for a pension, a 401k, or whatever it may be, right?
And all of those disappear now.
Exactly. It's not like a disappear. For them it is. They just had
for the users.
Exactly. They had their pensions, their 401ks alongside coronavirus had a bigger economic impact than the financial collapse in 2008, which we will talk about. But they had their pensions, 401ks, all their savings that were invested into the stock market, and most of them are unaware it's invested into the stock market. They had that wiped out. Okay. But we understand that the market is just money being moved from hand to hand. For every buyer, there's a seller. You cannot have the market without having, like, if you are in a buy position and you want to close your buy on whatever instrument you are trading, you cannot close your buy and exit the market unless there's a seller on the other side. Right?
Exactly. Yeah.
It's just in our modern markets that it's such an instantaneous process because you have people in institutions trading around the world every single second. Okay. So when that collapse happened, and understand when the stock markets crashed, the central banks, specifically we're talking about USA here, so we're talking about the Federal Reserve. These guys aren't some Joe Schmoes, average Joes. These are economists. These are financial market experts. These are the guys who are dictating the flow of money for the US dollar. You don't think they were well aware of the impact it was going to have on financial markets, right? So
Yeah.
my question is, when the markets were crashing and you saw Dow Jones fall 10,000 points.
Yeah, it wiped, Dow Jones wiped everything that Donald Trump did in like a month.
Exactly. It wiped
Yeah,
more than that, like for
yeah,
years worth, right?
yeah,
So while it was falling and all those financial gains are getting marked, or sorry, are getting wiped out of the market, right? All those financial gains that, think about it, are coming from the working class people. The majority of it is coming from their 401ks, their pensions, their investment with their banks, their retirements, whatever it may be, right?
Hmm.
When the stock market is falling, how come the feds didn't stop it halfway, a quarter way through the collapse? How come they didn't stop it halfway through the collapse? How come they waited for Dow Jones or for S&P or NASDAQ to wipe out 5 years worth of gains before they finally jumped in and started injecting the markets? It's
Yeah, they
because
picked it up at a much lower price.
exactly,
Yeah,
right? It's because it's just a game. It's a game of buy and sell. So when the market was crashing and then you saw Dow Jones, for example, go from 29,000 points, like near record highs, fall all the way to 18K, that 10,000 point collapse, it sets up a perfect buy entries for the 1% out there, the institutions, the 1% who have liquidity. And they were the same ones who were short selling on what, because they were aware of what's happening in the economy. They're aware that the market is going to take that hit, the economic cycle we are in, the fact that everybody's losing their jobs, etc. So while the average 99 percenter is losing their pension, job, and 401k, that money is moving from their hands to the hands of the 1%, who the 1% then takes that massive amounts of liquidity from the average working class person, and they are now buying the US stock market from those lows.
yeah.
And what
So
and
they shorted it from the top, and
exactly,
they now bought everything back undervalued, underpriced.
undervalued, underpriced, and this is what is called like a transfer of wealth, the greatest
Yeah.
transfer of wealth.
It's
So
always during the recession, guys. It is where the most transfer of wealth happens. It means where the money switches around the world, and it mostly
yeah,
goes, as Jeff was saying, from the 99% to the 1%, to the banks, to the
exactly.
institutions, to the etc.
The banks and institutions, they even in 2008, they just get bailed out, and they get bailed out by the working class people, by taxpayer money. So what on now, it's not just the fact that they jumped in from this low point, right? Because think about it, once the average working person gets all their money wiped out, they don't have anything left to invest. So who was in the stock market at these low points from 18K? It was the 1% that has that liquidity, that was aware of what is going on.
The
And
people that handled the drop, and it's not the average Joe.
exactly.
Yeah.
And at that low point, now what do they have the support of? Because they're not playing a guessing game of the market is going to continue to drop. Because at randomly at 18K, who is now jumping in and mass printing US dollars to inject and create this V-shaped recovery? It's the Federal
Yeah,
Reserve,
the Federal Reserve, exactly.
right? So
Yeah.
what have we seen happen in turn of so what makes me angry is that it's the 99%, it's the working class people that lose. The second thing is the Federal Reserve, these economists, the one percenters, the banks, they're not dumb. They can fully see the signs years ahead of when a potential market crash or an economic cycle is turning. They see the signs, right? The Federal
Correct.
Reserve just dealt with this in 2008. They know exactly when the signs are building or when the economy is coming into a different state. But this transfer of wealth is meant to happen because it keeps power and it keeps the status quo. It keeps everything in line as it's meant to be. It's that common saying, the rich get richer and the poor get poorer, right?
Yes. Yes. Because it's a loop and it keeps on coming. A recession after a
Exactly.
recession, a recession
Exactly.
after a recession. And it is when they make the most money.
Exactly. So
Mm.
now what did we notice? That even though everybody lost their jobs, the unemployment figures and the jobless claim figures were in the millions in the US and around the world, global equities, global stock markets still continued their rise. Why? Because at the point of the crash is when the correlated central banks, whether it's the Bank of Canada for Canada, whether it's the Euro Central Bank for EU, or whether it's the Federal Reserve for US, that is when they started printing more of their correlated dollars and putting it into the money markets. So the way the Federal Reserve does it, they call it quantitative easing, QE. They buy US bonds and securities. They're pretty much like an IOU, where the US says, okay, and the Federal Reserve will give them cash flow for this bond or for the securities or whatever amount, millions and billions amount they purchase for that. And this is an IOU. This is debt that the US government owes to the Federal Reserve. Every single dollar that comes from a central bank and is given to the government in exchange for purchasing of bonds, government bonds or securities, it is essentially debt. It is essentially a loan the government is taking from the central bank, just like we would go to our local bank to get a loan that we have to pay back that has what? Interest on it. Correct. Right?
Correct.
So what we noticed when the US, so this is something you can just go pull up your charts right now and check. You'll see the correlation, right? And you did a very good job explaining it in your article when you're talking about the money supply, right?
Exactly. So I will actually put that up.
Yeah, pull that up.
Where this is the money supply. The blue line is the money supply here. Mm-hmm. And the red line, you can see the S&P 500. And you can see all of a sudden here on 1st of February, do you see how the blue line, the money supply shot up all of a sudden? And you see how the S&P followed?
So the Federal Reserve is increasing the printing of US dollars. It's not physical printing, it's just digital, but they are increasing the rate of production on US dollars to inject the money markets and then create that artificial V-shaped recovery that's riding with the 1%. But you know what you can also notice? That we all understand that everything runs on supply and demand, right? It doesn't matter if it's a product or an instrument.
The basis of all this,
right? So do you see how you see how the money supply of US dollar had that heavy spike, right?
Yeah.
Just like that helped support the US economy, it also had a negative short-term impact on the value of US dollars. Because what do you have happening now? You have, yes, global equities are strong, but when the US Federal Reserve is printing mass amounts of US dollars to help inflate the global, like help inflate US equity specifically, investors and institutions are now jumping in equities and staying out and keeping their money out of the US dollar. And at the same time, the US dollar is heavily, heavily oversupplied. It's getting inflated, right?
Correct, exactly.
So if you pull up a dollar index chart, like the Dixie chart,
we can do that.
Right? And you just go to like the daily, right? You will see the exact opposite.
Yeah.
From the February point, the US dollar was extremely strong, but the exact opposite happened when the US, let's just say from that March-April point, when we started noticing that global equities were bouncing back, US equities were having that V-shaped rebound because the Federal Reserve was pumping the US markets with US dollars and printing more of it. This also created an oversupply in US dollars, where if something is oversupplied and under demand, what happens? The value of it drops, right?
It decreases, yeah.
It decreases.
And it is exactly what we saw with oil happening a couple months back.
When oil was just heavily oversupplied around the world, but there was no demand because of coronavirus just shutting down everything.
And the lockdowns between countries and airlines and everything was shut. And countries itself were locked down as well.
There was no usage of oil, but there was still heavy supply and production. So we had price literally go into the negatives, right?
Yeah.
So now the same time, we have noticed that the global equities are rebounding. The Feds are printing out endless supply of US dollars to support the markets. We have all these benefits that are being given out to people that lost jobs. This is also having a short-term negative impact you can see on the actual US dollar itself as a whole, right? because the US dollar, US equities, and the US economy are all different. A lot of people confuse the three because the US stock market, the US dollar, and the US economy, even though they work in hand, they are different beasts, right? Because just like you were discussing, at the same time we're noticing the US dollar is extremely weak. It's also helping to inflate the price of US equities and stocks. Why? Because the Federal Reserves and the institutions rather have temporary weakness on the US dollar than have major collapse in the US markets, because if the US markets collapse, it's not just a financial impact. All of those companies that are listed on those exchanges go bankrupt.
Exactly. And then bankruptcy laws apply, which means less taxes.
Right. And very similar to like, remember we saw the fear of when oil was going into the negatives, and then you saw all these politicians from Trump to politicians in Saudi Arabia, energy ministers.
And Russia,
Russia, they all started going crazy because if oil stayed that bearish, all those oil companies around the world would have gone bankrupt because they cannot turn a profit, right?
Correct. And some oil plants didn't actually handle the drop. And did go bankrupt.
They did go, a lot of them did go bankrupt and they lost everything. So think about that same concept of an oil company not being able to make profit if the price of oil is way too low, right? If that same concept applies, if the stock market is extremely weak and stays at extremely weak points for an extended period of time, all those individual companies' stock value goes down, and their overall company valuations and profit starts to decrease from an investor perspective, and this will in turn impact their like production, their productivity, the services they pay for, everything. It goes down in line. It's a big ripple effect, right?
Yeah, correct.
So the U.S. government and the Federal Reserve can't afford that. They can't afford to let the stock market actually crash. They can afford to let it take a big hit to have that transfer of wealth, and then they start pumping it with US dollars to bring the markets back up. And they can afford for the US dollar to be temporarily weakened because the Federal Reserve can dictate the price of the US dollar like that. If they want to start cutting how much US dollars they're putting into the market, they can do that when the time comes. They can increase their interest rates, et cetera, et cetera. They have those tools available, right? But it's very hard to recover hundreds to thousands of individual companies across sectors, healthcare, technology, energy, whatever it may be. All those companies are housed within these stock exchanges, right?
Yeah.
So, yeah.
Okay, I understand. Well, it's a different perspective. I didn't think of it exactly that way, but you're saying it was actually easy, or let's say less harmful for the Federal Reserve and the U.S. government to weaken the dollar index instead of having the S&Ps and the stock market crash.
Exactly. It's less harmful for them to just have the US dollar get inflated short term and watch inflation and keep printing more of it than to let the market crash. Exactly. The market crash would lead to all those companies going down and then more jobs lost, and the jobs lost would be exponential, right? And there was and the difference with coronavirus compared to any other financial collapse we have seen is that we have never witnessed a global grand scale lockdown of multiple industries just going completely from 100% productivity, whether it's like any industry, right? Going from 100% productivity and output to zero, to like almost 0%, right? It was one of the reasons gold was so valuable, because like we were talking about supply and demand, when coronavirus was shutting down industries across the globe, it also shut down gold mines. It also shut down gold production. So what did you have? You had mass market fear, which increases the appeal of safe havens. At the same time, you had the gold supply being limited. So exactly the same thing, but you have a limited supply and low supply of this physical precious metal, but a very high demand. So price was just booming on gold, right? It went to the 2000s. So it's crazy.
So Jeff, if I can comment on this, you were saying moments ago that the Federal Reserve can afford to lower the interest rate and inflate actually the dollar. So what do you think caused the what do you call it disinflationary turn in April, whereby the U.S. inflation rate dropped from 1.5% to 0.3 in April and then to 0.1 in May. So if the money is available and the supply is available, why did disinflationary like events happen to the U.S. economy?
Well, that was also because you have to think about the whole consumer side sentiment, the whole consumer behavior side was completely shifted, right? So the actions they took regarding inflation were adapted to specifically what was going on with coronavirus. Because from an economic standpoint, even though a lot of this could be expected as per the market impact, like I said, I don't know about in your guys' lifetime. In my lifetime, there's never been something so widespread that impacted everything down the line, and especially like consumer inflation, consumer behavior as well, right? So when the Federal Reserve are looking at these inflation figures, one of the main things they're looking at is, of course, the consumer and the producer inflation figures, right? So you had a negative impact on the consumer inflation for such an extended period of time with the global lockdowns.
So basically, what you're trying to say is the Federal Reserve gave all these new printed supply to the big guys and left the average Joe to spend from his savings account, and that's why the economy was short of supply in regards to the, let's say, the population and not the big guys.
Yeah, like those, even like for example, that in Canada it's called the CERB. In the US, I don't know what the benefit the government was giving out to the American citizens every month was called, but these different care packages by these countries, it's not that much money in retrospect compared to the amount of money the central banks are respectively giving to the institutions. It's a very small percent, right? Because they're not just like they weren't worried. Like, for example, we saw global equities take that massive crash and then have a full V-shaped recovery right now, while the average person is still not working and still working off that benefit or lost their job. So it's not like the central banks or the governments ever have the people's intentions in mind. So
that's for sure.
Yeah, so that's what I mean. Like the big guys, they got what they needed. The little guys are still suffering in that sense or have that mass fear around them. So I saw it in two different ways. There was the fear and greed scale on the market and by traders, which even though there was mass fear in the consumer side of the people, like the working class people, the users, even though all this optimism has been happening in the markets where we're seeing these V-shaped recoveries, if you go talk to like a regular average person, they're still scared of coronavirus, right? Like they're very like they don't, and I'm not trying to judge anybody, but the 64 people in this chat, the people in Uncle Bull's chat or my chat, we think differently. We're more involved in this stuff. We're watching it every day. We want to know the impact. We're asking questions, where the average person is very lost. You know what I mean? Like they are
I
very,
understand you.
Yeah, so they're constantly,
they don't know what to do next.
Exactly. They don't know what to do. They don't know what's going on. They're just following orders as they come, and that is it, right? So the average person is still having a mass fear around coronavirus, which has impacted the majority mass consumer behavior. And consumer behavior, consumer activity is really what, alongside jobs, is what drives an economy, right? You have people working. If people get paid well, they take that money and they go put it back into the economy by buying
money
goods.
velocity flowing through the economy.
Exactly. So that has been heavily impacted on the consumer side by the coronavirus fears and the lockdowns. Like just from a social perspective, if you go out in public right now and sneeze, people are gonna fucking stare at you like you're a zombie. You know what I mean? Like it's crazy.
I understand.
Yeah. So yeah, that's just my view on that side.
Yeah, but so I read an interesting article like a few months ago, and it said that young investors who were bored at home were piling into stocks by registering to Robinhood and
I
these
heard
kind of things.
about that article. Yeah.
Yeah. So, do you think like this V-shaped recovery is, let's say, a trap for the average Joe and an opportunity for the big guys to unload their gains on them. Because as you said, for every sale, there has to be a buy.
Yeah.
And if the stock market gets very expensive and stocks get very expensive, the average Joe can't afford it, then nobody will be buying from these big guys.
Mm-hmm. So, are you trying to say like, will there be another big hit on the U.S. equities, on the U.S. stock market?
Yeah, I guess.
I
I
think
guess
so.
so.
I think so because but it really depends on everything that happens, especially around the U.S. elections, is going to bring a lot of volatility, of course, and
Yeah, that's for sure.
and now we're just watching if there's going to be a potential about the wave 2 lockdown, right? So to me, one of the main things that would cause a potential another crash would be is what you said, something we wouldn't hear about in mainstream media. It would just be the big boys closing off a lot of their gains and cashing out of the market, and a lot of the people who are trying to buy into the hype now will get taken out. And
Yeah,
the
that's what I
next,
mean. Like
right?
buying the hype is always, as they say, retail traders buy the top.
Yeah, it always is. The market wouldn't exist if those guys weren't in there. It's just like that's just based on trading psychology. People always doing these bad behavioral traits and repeating it. But the other way is if economies become stagnant again. Like for example, when we saw the market crash or take that first initial hit, it wasn't because of coronavirus fears. It was because
No, it
coronavirus
wasn't.
fears led to a lockdown, which led to jobs being lost, economies being stagnant, right? So that is
Yeah.
why even though we have seen, even though through this whole V-shaped recovery, we have seen still tons of headlines about people dying from coronavirus spreading, potential wave 2. It's still in the headlines. It's still in mainstream media, but it lost its financial impact because we are coming out of lockdowns and people are starting to go back to work, and because of that massive stimulus from central banks, right? So even
So
if we have,
what I
yeah,
think is happening here, it's like neural programming, or what the media is trying to program people to do. Because as you said, like the crash didn't happen for sure because of the coronavirus.
yeah,
We sent an article, an interesting article, to be honest, on Uncle Bull, like in March before the drop. And it said that a record number of 1,600 major CEOs resigned or stepped down in the last few months leading to 2020.
yeah,
And among the big names were like Bill Gates, CEO of Microsoft, Larry Page, and Sergey Brin, of founders of Google. You had the
yeah.
CEO of eBay, IBM, MasterCard, Boeing, McDonald's, and very big names actually were resigning or stepping down just before the crash. Do you think they had the knowledge of
Yeah,
coronavirus or
these guys, like, there's a ton of people that are just as wealthy as those guys, but they are just not known. They're not, like, we're not going to hear about them. But these guys, they are a part of that. They are a part of that 1%, right? Like they would 100% have the connections to understand, because it's not like Bill Gates with his billions of dollars. He does his own personal financial investing. You know what I mean?
no,
He has he has
doesn't?
he has a whole team of guys that do that. He's best friends with Warren Buffett. Like even like for example, Jeff Bezos. He didn't obviously resign or do anything, but he sold off thousands of Amazon shares before the market crash happened, then rebought them.
Yes, he did.
Right?
Yes, he did.
And this same guy, Jeff Bezos, when he's hosting a house party, guess who was at his house party? Fucking Jerome Powell, head of the Federal Reserve. Right?
Yes.
So think about these guys' connections, who they hang around with, and then that same guy where it's Jerome Powell is dressing up in a suit going to Jeff Bezos' house party. A week later, he's giving a U.S. interest rate speech
Decision.
that's going to impact the markets. That's going to impact the dollar. You don't think these guys are talking? Think about it.
Yeah.
Even
They
us,
did. They did.
right? Even
They did.
us, if and we can't say that they're greedy, that they're evil, whatever it is. It's just human nature. Because if you put any of us in their shoes, if you gave me the power Donald Trump has, I would be messaging Uncle Bull too, saying, "Hey, in 1 hour, I'm gonna go speak, buy gold right now, sell this." You know what I mean? We would all do the same thing if we were in those positions. Like if you had the power to impact oil price or to impact the stock market price or to impact the dollar, we would all be in that same boat, right? So it's just human nature. But
Yeah, I
Yeah,
can agree with that.
but I want to take the conversation back again to the CARES Act when we were talking about the helicopter money coming in for the people that were unemployed at the time in the US. What was it called? You said in Canada.
It's called
It
like the
was
CERB or something like that. I don't know.
yeah,
It's all gonna be debt that we're gonna have to pay back.
exactly. But uh, if I'm not mistaken, this has a deadline that has ended.
Yeah,
Um,
it did end in July, July 31st, and the Congress is now discussing another
Discussing another
stimulus
one
bill.
for another trillion or something like that, right?
Yeah, something like this. Do you think like um, when the elections are done and everything like in the political sphere, let's say
I
it
think
settles down?
coronavirus is gonna magically disappear right after elections. That's what I
Yeah,
think.
that's expected.
Yeah.
yeah.
Like, do you think like if the stimulus bill finishes like at the end of 2020, what do you imagine happening like to the average consumers and the average Joe and average investors?
The way first, just let me give my perspective on like what I think would have been most optimal for the person and for the consumer, but like when they were first introducing all this stuff is for one thing, if a lot of you guys have looked up the actual medical impacts of coronavirus, it's not that much deadlier than the regular flu, right? So
No, it is not.
yes, the coronavirus is very real, but it's just another strain of the influenza. There are many things in this world that kill more people daily, including something as basic as world hunger, right? Hunger. More people die from not having food than the coronavirus or whatever it may be, but you don't see that in mainstream media or mass fear around that, okay? So one thing is the media and the governments heavily increased the global fear around coronavirus so it would have more social and financial impact. So if they were really following the actual health impact of coronavirus, they would have been following more lockdown easing measures earlier. So what something I would have done from a financial standpoint is I would have not given anybody a single dollar of benefit unless they actually can prove that their job was lost, and there would and I wouldn't have had a lockdown anyways, right? Because first of all, coronavirus is not that dangerous when you're actually looking at the health impacts of it. It's just another influenza. I would have had income tax cut for the year, okay? Because this
Mhm.
would promote more people to work, and you would still be following the same safety measures and things we are following now with masks, gloves, whatever the hoopla they want you to do. You would still be following that same safety measure, but when you cut people's income taxes and they can earn 10, 20, 30% more each paycheck, right? They are one going to be more motivated to actually work because they're going to be earning more money, and two, that money is still going to be circulated into the economy and the government is going to make just as much off sales tax. Most countries, everything you pay for, whether it's a home, a car, something to eat, clothing, it has sales tax, right? So
Yeah,
when
value added tax in the Middle
right,
East.
everything is taxed like in North America for sure. So when you have people earning 20 to 30% more money and you have people working instead of people sitting on their ass waiting for a check to come in, right? One, you have less jobs lost. Two, you have less fear around coronavirus because you're actually focusing on the real health impacts of it. And three, you still have money being made and circulating in your economy and just as much coming from taxes, because that 20 to 30% people earn, they're gonna spend it eventually. Money's meant to be spent. Even though you might save for a year because you want a nice car, or save for 5 years because you want a house, eventually you're gonna spend that dollar. You're gonna spend the money, right? So when you
That's
spend
true.
that money, it goes back into the economy. It goes back collected via sales taxes. So that 20 to 30% that each working class person is earning more is going to go back into the economy and help that circulation. So to me, when I saw that they instantly went into lockdowns for something that is about as dangerous as any other influenza, and the fact that they started instantly printing out money to give to people instead of cutting income tax, right? Because at the end of the day, all these people got benefits, but you're still going to have the IRS in the US or the CRA in Canada, the tax man in any country. He's still going to say, hey, you owe me X amount of dollars, right?
Yeah, yeah,
So it's
that's
not like
for sure.
right? So when I started seeing that they were not cutting taxes, they're not helping people get jobs or keep jobs, they're only printing out more debt that is coming from the central banks, and a portion of that is going to be given to the people. I just saw this as more debt being built up, and at the same time, you're getting people comfortable with not working, right?
So one thing is, you said they did actually provide some protection to the people. First, they introduced eviction bans, so nobody can be kicked out of homes,
Oh yeah, and
of
stuff
their house.
like they deferred the mortgage payments and
Yeah,
stuff like
they
that
did
for 6 months.
some things like this, including like the furlough or the what they call the layoff protection. So you're not allowed to lay off people
That's true.
until November or something like this. But as you said, maybe it was all a game because if the money velocity keeps increasing and the Federal Reserve prints more money, then this increased amount of money will be going through the economy faster. So
Yeah.
maybe with the lockdown and with the decreased money velocity, they can print as much money as they can because it will not be going anywhere, and inflation won't hit like the hyperinflation hype they
Yeah, like
used to say.
they're monitoring that a lot closer. There's a lot of the money, like we were talking about, has been given to the institutions and the banks, of course, and then a small portion of it has been given to the working class people and the
Yeah, and
users.
the banks are not lending.
Exactly, they're not lending, so
So
that's
what's the
exactly
point?
what's happening now. So we're not so that risk of hyperinflation has been decreased, even though there's so much US dollars actually being printed.
Yeah, man, that's our point. That's what we pointed out in our
Mm-hmm.
article. We said like, if you look at what the banks are doing from the beginning of 2020, they started increasing their lending standards. So if you want to go to get a credit card right now in the US, it would be much more difficult actually to get one than it used to be in the financial crash in 2008. And this is coming like directly from the Federal Reserve System and the statistics. So why are the banks tightening the standards when they have a lot of money?
Yeah,
Let's say free money.
because they know they know the economies are not healthy enough to support it.
So that's clear for the banks, but not clear for the government.
Yeah, I guess the governments are just as, you know what I mean, but it's the governments more comes down to like their individual policies and what they're doing, and like it depends on the country itself. But for the US, yeah, it's clear for the banks, but not clear for the government at all.
So let's say um, we have another round of coronavirus coming soon, and we have another lockdown.
Mm-hmm.
Do you think, like, as you said, the Federal Reserve has some tools like increasing the what they call the interest rate. So with everybody now is in debt right now, if they increase including the big corporations and the small businesses who suffer the most.
Mm-hmm.
So if they did increase like the interest rate by half a point or base point, what do you think this will affect?
Well, usually the interest rate is only increased during times of like economic recovery or when the economies are stronger, right? So I think what we were talking about, if there's another lockdown and economies become stagnant, I think that would be I don't think the Federal Reserve would jump in automatically again. I think that would be the perfect time for all those big boys, the 1%ers, the institutions, to offload their equity long positions and get out of the market as well. And then the federal and then guess who's going to offload them when it hits a low point again? The Federal Reserve is going to jump back in with more quantitative easing from whatever low point and relieve them. The money's just going back and forth between these big banks and corporations and the 1% in the Federal Reserve, really, as little scraps are being given to the people. You know what I mean?
And we're trying to take our intraday levels in between.
Exactly. We're trying as traders, we can jump in and do a lot. But when we're just talking from a macro perspective, all you're really having is money going back and forth between the feds who supply the US dollar and then all the corporations and companies who use and invest with the US dollar in the US equities. So So let's just say there's another lockdown and the US dollar has this heavy supply. The Federal Reserve has this heavy supply of US dollars still ready to go, and inflation is not heavily spiking, right? If the markets take another hit from a lockdown perspective and those buyers in the market are closing their positions, the Feds are just going to jump in to relieve them. The money's just going back to them.
Yeah, but do you think like the big, as you say, the big players will know in advance?
100%.
So that's the point of like Robinhood now, or they introduced a feature called percentage shares or something like this. Like you can buy what is they called, a portion of a share or something like this. They are trying to suck every dollar into the market.
They're even doing that. You can buy a portion of a stock now, not even a full stock.
Yeah,
that's crazy. That's
yeah.
like
So they are trying actually to collect like
any
all
dollar,
the money.
any $1 somebody
yeah.
wants to invest, they'll take it. Yeah.
Yeah, that's actually what happened historically just before big crashes happened. Like, you know, in 2008 when they introduced the e-minis and the micros and these kind of things, it was just around the top of the crash. Like they took everybody's money in and then they locked the market. Goodbye, everybody. The crash came and then everybody had to.
And all those average Joe Schmoes, they get flooded out, right? So
yeah, they had to sell at low prices.
Yeah, but honestly, right now it is it's very up in the air just because it's something we have to watch and observe day by day, because again, it's something we have never experienced in our lifetime, right? Like with this whole lockdown coronavirus, it was just insane. So
somebody's saying it's called fractional shares. Yeah, they have fractional shares, and they have something. They have something like called e-slices at Schwab's. They introduced something.
Can anybody explain the tension between China and USA? That's been ongoing since like 2018 now, the US-China trade war.
I think this is a story like they are trying to bring in every now and then, like to give hope to the market when they are dropping.
Yeah.
They are using it like a tool.
Mm-hmm.
But I don't think it has a direct effect on the market because, you know, China is imposing tax and then US is also imposing taxes. And the only one who's paying it is the average Joe or the consumer. They are paying the taxes.
Yeah. It just depends. The only impact really that you'll see day-to-day volatility impact from these USA and China. Like let's just say Trump says we're stopping the importing of XYZ good completely, or we're no longer or China says we're no longer buying USA agriculture.
Something.
You know what I mean? Something like that. That of course can have intraday impacts, of course, to like the US dollar itself or the potential
Chinese,
markets. Yeah, you know what I mean? But there hasn't been anything too long standing that would really change the financial markets between the USA and China, unless they go into a Cold War, unless they come to no trade deal agreements and they have a what's called an economic war with each other, where they just restrict business, where they just restrict foreign business, they restrict imports and exports between those two countries, then that can start to have a massive impact on economies and jobs and going down the line, right? Because there's so much there's so much on a global scale.
Yeah, the thing is, so from reading all about China and the US, what I'm trying to see is, or what I'm coming to see basically, is they are increasing the taxes on both products. China is increasing the taxes on the US product, and US is increasing the taxes on the Chinese product. And
so the person who collects offsets it. It just offsets each other.
So what's the point? It's a zero-sum game, and the only beneficiary is the government because they are collecting more taxes. So where is the war?
Exactly. So the wars against the people still.
Yeah, everybody's saying, no, we hate China, we are boycotting, we are not downloading TikTok and WeChat and these kind of things. But the average people are paying the price to the government of this war.
Yeah.
Do you think we might expect another civil war? I don't think civil war or war is on the cards for anything, really.
there is possible for like an economic depression, yeah, but I don't know about an actual, maybe just in the US there could be, like obviously it'd be in the US only if it's a civil war, but I don't know, because war nowadays is just directly
It's
connected to
different. It's
nukes.
different types of wars now.
Yeah,
It's not guns and tanks anymore.
yeah, they don't
Like,
do that because if a war really gets that violent and physical, especially a global war, everybody's dead, right? We're all gonna like it's gonna go into
nobody's
a
making money.
yeah, you're going into a nuclear winter, like a nuclear holocaust around the world, right? Like a
Yeah.
thing would be like that. So, I don't know. I don't know about any. I think all physical war type of stuff is just more threats, and you see little attacks here and there. Like there's been war going on nonstop for the last 30 years that we just won't hear about in the media, right? Middle East been getting bombed every day by the U.S. still, right?
Yeah.
Just
Yeah,
recently
that's
stuff.
the,
You know what
they
I
are
mean?
aiming for the oil. You see,
Exactly.
I read an article yesterday that the US is sending more like military equipment and tanks
They
to
want.
to Syria, despite the fact that Trump said like 3 months ago we're out of Syria. So
It's
there's a
because.
contradiction.
Yeah, it's because of the oil, the power. Like the U.S. and Saudi want control of the Strait of Hormuz so badly because it would bring so much oil demand towards them, right? Global oil
Mm.
demand. So yeah, it's just insane to see. Like there's
Which is
always
bad for China because
yeah.
China doesn't have access to, like, say, their Iran, for example. They can't get oil from Iran easily because of the US sanctions.
They
So,
but did you read about that even after the Iran sanctions, the U.S. sanctioned Iranian oil, they were taking in millions of barrels backdoor, they call it.
Yeah, yeah, and that
yeah,
happened
that
before the
happened.
crash as well.
Before the crash.
Yeah.
Before
So
they were
they
too prepared.
yeah, so China right now to this day has millions of barrels of Iranian oil stocked up on their ports still. It's crazy.
Yeah, it is. It is very fishy that it has happened before the crash. They were like,
Yeah.
it's almost like they knew this will happen. This
And they
crash
had
will
and they
happen,
had
and
this huge stock.
yeah, and they were fully prepared for an economic rebound.
Yeah. Think about it. Think about how much information we get from looking at just like headlines, volatility, these different economic indicators, just from our free resources of like using the internet and like technical charting, right?
Yeah.
Think about that scale for a country with billions and trillions of dollars in resources. The way we're looking ahead in the future of the markets, maybe a day or two, or trying to forecast things. These guys
Yeah.
are looking ahead years, right? Like
Exactly,
Yeah,
crazy.
they are
exactly.
Yeah,
preparing for
like
generations.
they have. Yeah,
It isn't no 50 pip move.
yeah. It's a completely
Yeah.
different game. Like they have, just like we are market analysis. These guys have full paid people that are getting paid $100,000 a year just to look at this one piece of financial data and analyze it. You know what I mean? Like
Yeah.
it's crazy. So what are the
Yeah,
biggest
we're definitely like to all the guys that are watching, like don't get it mistaken. We are definitely in a rigged game.
yeah,
Yeah,
100%.
we are definitely in a rigged game, but you can take a small percentage of the pie, and that small percentage is
We
huge.
can eventually over obviously I hate giving people false expectations in trading, right? I hate telling people
Yeah.
like follow this technical method, you can make hundreds of thousands of
That
dollars.
doesn't work.
I hate
We've
that,
said it
right?
before.
But
Yeah,
if
we've said it before. There's no one technical method
yeah,
that works every time.
but if we are doing what we are doing right now, having these discussions with other traders and increasing our own knowledge and experience, analyzing these real world events, economic data, understanding the impact, taking trades. If we are doing this now, imagine our experience, chart hours, knowledge 5 years from now, 10 years from now,
Exactly,
right?
exactly. And the key thing is, which is what you mentioned. The key thing from what you mentioned was adapting.
Exactly.
So it's not just one strategy that you keep on following, regardless of whatever's going around in the world. You know, if it's a
Yeah.
pandemic or if the economy is booming or whatever. It is. Don't just look at a trend or say, like, for example, this is a bullish trend, this is a bearish. Like, what's the reason behind it? Will it
Exactly.
continue? Why is this happening? Like, ask yourself these questions. fundamentally, then look for technical confirmations to enter.
Exactly.
But
A perfect example of this is if you pull up GJ just on the 4 hour.
Yeah, absolutely.
So GJ, if you just zoom out a little bit here, can I annotate on the screen?
No. Wait. Yeah, now you can.
Just zoom out a bit. Yeah, so GJ, even if you zoom out further, you could see long-standing bullish market structure for like a month period, right?
Yeah.
So here you go. You can see long-standing bullish market structure, right? So technically, for most traders, we're just given the example of, so this V-shaped recovery we even saw in equities on GJ specifically is because we saw global equities start to become, we saw global equities rebound, and what I call risk currencies start to get picked up from their lows, just like anything buy low, sell high for the big players out there, right? And we had this trend that was in line with the global equities rebound, where when you have a pair like GBP, JPY, I call GBP a risk currency and the Japanese yen is a safe haven currency. So
we talked about that as well, right? In our latest, our previous.
So you have your main safe haven currencies. In this situation, we had the US dollar, the Japanese yen, and the Swiss franc.
Swiss franc, yeah.
Right? So when we had very optimistic markets and you have market greed is stronger than the market fear, and you're having the Federal Reserves heavily stimulate the respected economies, right? Like the Bank of England for GBP, you're going to have risk currencies be a lot more appealing from their lows, and the safe haven currencies deflate. So for that long-standing period, we had this bullish market structure being respected up until we recently peaked a new high. And then think about how many technical buyers would be jumping in buys at this retest of market structure because it's a bullish technical trend line, right?
Exactly.
When if you were identifying what was happening fundamentally on,
you would have known
all the Brexit stuff coming out, right?
Exactly.
So that is a perfect example just in real time where you could look at this period in time, you could look at the Japanese yen index specifically, like the JXY, and noticing that it was turning more bullish and sellers on that were failing to break previous lows. And you could also notice that price on the lower time frames are starting to break structure. And when you were examining your headlines, we had mass market fear coming in for GBP specifically around all this Brexit negativity and potential lockdowns continuing, right? In the UK specifically. So you had this one-sided volatility where if you were just trading technicals, you would be like, oh, this is a retest of a previous high. We're holding support here. We're holding bullish structure. Buy.
Yeah.
Right?
Yeah, exactly.
If you're not monitoring the real world events of all this Brexit negativity and understanding there's more seller's pressure on the British pound because of these political disputes going on and the Japanese yen is picking up strength, then you can identify and start taking advantage of this shift in structure. Now these points that were previously a support for buyers are being used as sell entries for order flow.
Exactly. This is actually a perfect retest.
Right?
Oh, sorry, my bad.
Yeah, you can delete that anyways, but I was just trying to show that example.
Yeah. So, but what you're saying is true. So, we had an overall very strong bullish trend. It peaked at a high over here, and if you were paying attention fundamentally, you would realize like the retest of the trend line wouldn't have been a good buy for you.
Right?
You know,
you would understand. So,
but also like looking at it now, there were great opportunities technically as well to enter sells. Here, the break of the trend line, the break of support, the retest here.
And look at like the size, look at the shift. So when you're having these optimistic markets, you have very impulsive, strong buyers upside, and then you would have some corrective pullbacks or whatever it may be. You might have a corrective pullback, but once you have the liquidity generated, you push up to a new high, right? You have impulsive buyers candles. Once you had that break of structure with the fundamental catalyst of Brexit volatility, you have sellers impulsive candles and sellers impulsive moves and more corrective buyer upside. And there's only two ways liquidity can be generated in the market. It's either you have a consolidation period where buyers and sellers are not breaking previous highs and lows. And this is just liquidity and order flow being generated for what you call a technical breakout. But usually this technical breakout follows a fundamental catalyst, or you have price peak a high and have a strong move, a 50 to 60% correction, right? And then more order flow come in from that pullback, and then an extension to break that high, right? There's only those two ways that liquidity is generated in the market. If you start to look at the technicals, if you start to look at the technicals just as impulsive and corrective moves, as well as in that fashion of buyer and seller strength alongside market structure, your key price points, and then the fundamental catalyst day to day, it just brings you a lot of confidence that you understand what's happening and why it's happening. So when you go to execute on a trade, you have less worry when you're in that trade, right? So
exactly. So this is a really good example, and Jeff displayed it really well on the GJ chart of how to apply your fundamental knowledge and technical knowledge. So as we said, it is extremely important to keep up with the fundamental news, the political factors that are going on, and keeping up with everything that is going outside candles, outside the technical chart. And your technical chart should give you confirmation on how to enter.
Because remember, the technicals are a great visual tool, great to read the candles, but there's a reason those news terminals, like there's a reason Bloomberg terminal for economic data fundamentals costs $25,000 a year, but these trading view charts are free for anyone to go look at. Right? Like the economic data and what's really happening in the markets fundamentally is
what drives it. It is what makes those candles move the way they do, you know? Yeah, exactly.
So this whole time, you just had more positive headlines in the economy when you were having this bullish market structure. You were just like every pullback, as long as it held structure and you didn't have that negativity in the markets, global equities were still hot, et cetera, you just had your confirms to buy those pullbacks. But then we noticed that major shift fundamentally when you noticing all those negative headlines, et cetera. But yeah, here's a quick example there.
Well, actually, if I can pick your brain on one last thing, I would like to talk about something a little bit more technical. We can see here in the GPP, JPY, we had like a small consolidation area. It was ranging between, and then we saw this bearish breakout, this bearish candle breakout, or maybe a false breakout. But we know this was due to news, to an external factor, something I forgot what it was exactly.
Bank of England, the Bank of England interest rate.
So this happened, and then you see usually what I've noticed and what a lot of us have noticed with trading with time and experience on breakouts from consolidation areas or retracement areas or parallel channels or whatever, when they happen on news spikes or they're news related, something like the interest rate, 99% of the time they come to that statistic is not correct.
I know what you're saying. I know what you're trying to say.
Don't worry. They retrace back. And so we were talking about that, and we were discussing how to make the most use out of situation like that when you see a news spike heading like that. And when it retraces back, because we had this trade actually last week where we saw this breakout and we saw the pair moving back into this consolidation range, and we had this strong resistance level marked out, and we waited for another confirmation on the lower time frame, on the 1 hour time frame, for a breakout to the downside to re-enter sets, and we had like a short target. So I would like to pick your brain on news spikes and the way they affect like the candles immediately, and how can you enter, what you should look for when those type of situations happen.
So one thing about these news spikes is the correction move is always dependent on what is said during the statement or sentiment, right? Sometimes the Bank of England, they could be very directly negative, where price could just straight continue down or do a pullback and continue down, right? But if they are very mixed in their sentiment, which they were last time, you saw this spike down move, a very impulsive move, but because there wasn't enough fundamental validation during their sentiment and it was very mixed, and you had this impulsive move where so many other sellers would be jumping into the market after noticing this, most likely what happens is you have a correction and price just come back where more sellers are going to come in from better entry points that were not able to enter from the impulsive move area. Because a lot of people are going to be jumping in those downside sells instantly after they see this candle, right? After you see this big break of consolidation, you see this breakout, they're going to, any little pullback they see, they're going to be trying to enter sells without actually understanding what is being said live during the sentiment. Because this was still live when the sentiment was being stated. And then once we peak this low point, which is also around the 0.500, like a psychological price level, if you go to like the 1 minute time frame and just look at the structure here, just let me erase that. Just go back to that spike down, like the Bank of England.
So this was the
right. Yeah. So look on the lower time frame. You're getting the exact mirror move happening on the correction side that you can identify easier on the lower time frame. But this was the initial impulsive sellers move that was from the Bank of England having initially a more negative stance. And then you had price slowly creep down to peak these lows, where this is the first signs you're noticing sellers exhaustion. At the same time, you're noticing sellers exhaustion and some of these sellers closing off their order flow here, right?
Yeah.
Is when the Bank of England started giving more of a mixed sentiment. Then they started throwing in some positives about some of their economic data rebound and etc. What you want to identify is that you're getting a mirror move of the downside, which is not good to see, which that tells me a higher potential of a full correction happening of the upside move, and price is just going to range back into that intraday range until you have more confirms of one-sided volatility. So this initial impulsive move is very, very hard to play. So you have this initial impulsive move from the first few statements that were said from the Bank of England being very negative, pointing at the downside risks of GBP. And then you start to get some mixed statements where you're noticing the same time of those mixed statements, sellers are starting to close off some of their order flow in the lower time frame, which you can identify by the support being formed in the lower time frame. And then this break of minor structure here in this impulsive move up. This is the sellers closing off their orders from that impulsive move and buyers jumping back in. You literally get a mirror of that, where if you were watching the headlines as well, you would see it was due to mixed sentiment, mixed comments about GBP growth, okay? But because GBP is still overall bearish, because the structure is bearish, there's still the pressure on it from that Brexit negativity, this upside move also didn't break any highs or didn't break that resistance you were showing on the 1 minute, or sorry, on the 1 hour, right? So if you go back to
we stayed below 136, I think.
Exactly.
That was the key level.
So we still, like, even with that, what you want to identify is, okay, sellers initially had their impulsive move, but there was not enough validation of negativity from the Bank of England to continue the downside move. So price was corrected and that sentiment was waved off and price came back into range. But buyers also did not break 136 or this.
Which still gives us indication we're still in bearish momentum overall.
Exactly. So that bearish momentum, so this pretty much is just getting waved off as more of a neutral. This is pretty much, I just see banks making quick money off that sentiment, and then as you just have it getting waved off. This might as well be in my opinion, this might as well be a wick, because a bearish wick. It didn't break structure.
We call this a false breakout. So basically this is
right? So it might as well be a wick, a false breakout. But what you want to identify is even with this massive correction candle on an intraday perspective, and you had buyers jump back into the market on GBP, JPY, it still was not enough buyer order flow to break above 136 or to break above 136.5, that resistance there, or to shift the market structure, right? So it was just, that was just volatility induced and caused by the Bank of England sentiment. Because the Bank of England sentiment was very mixed, you just had that neutral move happen where nothing, where you had that neutral move happen where there was no significant change in price between buyers and sellers, right? And then you just overall, as that sentiment was waved off, we just continue with the overall GBP trend where price is most likely coming to revisit this low at least created, right? From that move 134.5.
Exactly. Yeah. I want to show you as well on the 1 hour time frame. If we can go back.
You're on the 1 minute right now.
1 minute, sorry.
Oh yeah, 1 minute. Yeah.
On the 1 minute time frame. Did you see the candle that spiked back up? Because I was watching it live.
We were in, we were doing a live price action session, and I don't know if some of the capital hungry guys are in the chat right now. We missed the Bank of England sells because we started a New York price action session around 7 a.m. and that was when the Bank of England stuff was happening. But we started to identify that seller, like what I was just showing you guys, that sellers were starting to exhaust here. You're getting a flat support, which is also around 134.500 nearly. And then we're getting a break of this minor bearish structure. We were looking for buys above a break of this minor level right here at 134.8, expecting a retest or correction to at least like 135, 135.5, 135, right?
Yeah.
So we took those buys after the Bank of England sentiment when we noticed it was neutral and just noticed a shift in price action. But we closed out here. And then I ended the stream. I was like, I'm going to sleep. And then this happened. Ask everybody. Then this happened like 5 minutes later after we ended the stream.
Man, this was, I was watching it and it was like a second. This candle was like a second. Yeah. It was like crazy. It just exploded.
Even though it was like 1 minute, I know what you're talking about. It was like 1 second, like actually.
Exactly. But it popped in 1 second and then it moved around for the rest of the minute. But yeah, it was shocking to see. It's hilarious that you closed out here.
Yeah, we closed out right there, ended the stream, and went to sleep. And then everyone's like, "Holy!" And then because you know how we still have those key level alerts, those price alerts.
Yeah.
So we were sitting around here at 135.2. I'm about to go in my bed, and I see the 136 alert get triggered.
Oh,
136 price, you know, like it's a nice flat key level. So we had an alert there, and I was like, wait a second, 136, is the alert broken? And I was like, and then I saw this 1 minute 80 pip candle, and I was like, wow, that's crazy.
Yeah. Well, sometimes you miss those, sometimes you catch them. But
and see how it rejected at 136 flat on the dot and the exact much
exactly.
Price point.
This was the key level. Wait a second,
right?
Yeah. This was the key level we gave out as well.
Trust me.
On Uncle Bull for the sell. So yeah, this was what we were looking at for me on the 1 hour. So yeah, so like we saw this was the
at least those targets to revisit those lows makes sense, right? Like
yeah. So then I saw another breakout on the downside on the 1 hour. Then I saw the 4 hour candle coming back and retesting previous support. I was looking to convert it into resistance before further dropping, and we ended up hitting our first target.
Yeah, it was a good one above that level.
But yeah, 136 was as long as it did not break 136, we were still in overall bearish
that was
momentum.
A good move.
Yeah. But Jeff, again, thank you so much for
no problem.
For joining us, and
hopefully it was useful, you know.
Yeah, absolutely, it was. It was very useful, and maybe I was thinking we could do a live session once for scalping and stuff like that, but we will talk about that later. But thank you again.
Yeah, just send me a message,
Yeah.
and then I'm gonna put this on my YouTube channel as well. I'll put it on the YouTube.
Yeah, I will download the video, edit it a little bit, and I'll send it to you. Thank you, guys, all
For
for
joining
joining.
in.
Yeah,
All right, yeah,
and
thank you guys for listening.
thank you, Jeff, and we'll continue. We'll stay in touch, and we'll see you guys around.
All right, take care.
You too.